Hey guys, what's up? This is Akanksha and welcome back to my YouTube channel. In this video, I will be covering one of the most important tools of technical analysis. Yes, I will be talking about different types of candlestick patterns that you can use for stocks, forex or crypto. It's easy to learn and it works. In one of my previous video, I talked about what is candlestick pattern and how to read them. If you haven't watched the video yet, then I'll put the link in the description box below as well as here. So go check that out. In this video, I will be talking about different kinds of candlestick patterns like bullish and bearish hammer, tweezer top and tweezer bottom, morning star and evening star candlestick patterns, bullish and bearish engulfing candles, and indecisive candlestick pattern. Candlestick pattern tells you the sentiments of the market if it is bullish or bearish. Many candlestick patterns have been used for centuries to predict the price movement and trends. There are nearly 60 plus candlestick patterns available, but in this video I am going to talk about top 5 patterns which I find really helpful for analyzing the price movement of any asset. So let's begin. The first candlestick pattern on my list is pin bar or hammer candlestick pattern. There are bullish and bearish hammer candlestick patterns. A bullish hammer has a small body and a longer wick which is 2 to 3 times of the body range. And the bearish hammer is the opposite of the bullish hammer or pin bar candle. It has a small body and a longer upper wick which is 2 to 3 times of the body range. So when you see them, they look like a hammer. So what does a bullish hammer means? When the market opens, the sellers control the movement and pushed the price down. And after that, the buyers stepped in and pushed the price higher. The buying pressure is so strong that it closed above the opening price. In short, a hammer is a bullish reversal candlestick pattern that shows rejection of lower prices. Now, what does a bearish hammer means? For the bearish hammer, when the market opens, the buyers control the movement and push the price higher. And after that, sellers stepped in and pushed the price lower. The selling pressure is so strong that it closed below the opening price. In short, a bearish hammer is a bearish reversal candlestick pattern that shows rejection of higher price. Now, just because you see a hammer, that doesn't mean the trend will reverse immediately. When you combine the hammer candlestick pattern with different support and resistance, moving averages and different indicators, then there is higher probability of trend reversal. The next candlestick pattern is a tweezer bottom or tweezer top. As the name suggests, they look like a pair of tweezers. A tweezer bottom or tweezer top is combination of two candles. On the first candle of a tweezer bottom, the sellers pushed the price lower and after that there was some buying pressure. On the second candle, the sellers again tried to push the price lower, but buyers dominated and pushed the price higher than the opening price. In short, a tweezer bottom tells you that there are more buying pressure than selling pressure in the market. A tweezer top is opposite of tweezer bottom candlestick pattern. On the first candle of tweezer top, the buyers pushed the price higher and after that there was some selling pressure. On the second candle, the buyers again tried to push the price higher but sellers dominated and pushed the price lower than opening price. In short, a tweezer top tells you that there are more selling pressure than buying pressure in the market. So when you see a tweezer top or tweezer bottom near a support or resistance level or any moving average, then there is more probability of trend reversal. The next candlestick pattern is morning star and evening star candlestick patterns. Morning star is a bullish reversal pattern. It is a combination of 3 candles in a specific manner. One bearish candle, gap down to a small candle. This candle can be bullish or bearish, but it should be small. It should look like an indecisive candle. That means it cannot be decided that the price will go up or down. And gap up to a bullish candle that close above the half body of the bearish candle. In short, a morning star tells you that the sellers are exhausted and the buyers are in control. Evening star is the opposite of the morning star candlestick pattern. It is a bearish reversal pattern. It is the combination of 3 candles in a specific manner. One bullish candle gap up to a small candle. This candle can be bearish or bullish, but it should be small. And gap down to a bearish candle that closed below the half body of the bullish candle. In short, an evening star tells you that the buyers are exhausted and the sellers are in control. So the combination of these 3 candles happening at support and resistance level or near any moving average gives high probability of trend reversal. The next pattern is engulfing candlestick pattern. There are bullish and bearish engulfing candlestick patterns. The bullish engulfing candlestick pattern is the combination of two candles. One small bearish candle and one large bullish candle whose body is bigger than the previous candle. And this is what a bullish engulfing pattern means. On the first candle of a bullish engulfing pattern, the sellers are in control as the close is lower than the open. But on the second candle, the buyers stepped in and price closes above the previous candle's high, which tells you that there are more buyers than sellers present in the current market. On the other hand, bearish engulfing candlestick pattern is also the combination of two candles, one small bullish candle and one large bearish candle whose body is bigger than the previous candle. The bearish candle body should cover the entire bullish candle. On the first candle of the bearish engulfing pattern, the buyers are in control as the close is higher than the open. But on the second candle, the sellers stepped in and price closes below the previous candle's low, which tells you that there are more sellers than buyers present in the current market. The set of these two candles appearing at support and resistance level or near the moving average line gives higher probability of trend reversal. The next candlestick pattern is indecision or indecisive candlestick pattern. Indecision candlestick pattern signifies that both buying and selling pressure are same in the market. Spinning top and dozy are indecisive candlestick patterns. In a spinning top candlestick pattern, both buying and selling pressure is fighting for control. You can recognize it when the candle has long upper and lower wick and also the candle has a small body. That means when the market opens, both buyers and sellers aggressively try to gain the control, but at the end of the session, neither has gained the upper hand. Also, a dozy candlestick patterns also represents the indecision in the market as both the buying and selling pressure are same. You can recognize it when the candles open and close are around the middle of the range and the upper and lower wick are short and about the same length. The candlestick pattern should be analyzed in the context of the price trend. So for example, a bullish candlestick pattern appears but it should be at a support level of an uptrend or at the bottom of the downtrend when the stock is in extreme oversold region. Only the candlestick patterns is not reliable unless you combine them with technical indicators like moving averages, RSI, support and resistance, trend lines, etc. All these topics I will be covering in my upcoming videos, so make sure you hit the subscribe button and stay tuned.